Everyone, Clint Lee here with your Big Picture, Big Profits Friday video. First things first, please like and subscribe to our channel, and I would love to have your comments below on today's topic. Now, about that topic, I want to go back in time just a little bit, but just a few days. I want to go back to the start of this week. It seemed like a normal start to the week, normal at least given the circumstances and challenges facing the world today. House Speaker Nancy Pelosi was visiting Ukraine for a photo op with President Zelensky. Chatter around the Fed meeting this week was starting to pick up. Stocks, they were beginning to recover from a really rough Friday last week. A trading session that saw the Dow Jones drop by over 900 points, which, by the way, I wasn't aware of this until someone pointed it out. That's its 15th largest point drop in history. But then over in Europe, around noon, traders were heading out for lunch, unaware that a much different kind of crash was stalking the market. It was one that would eventually wipe out about $315 billion in only 5 minutes. Once again, over $315 billion in just 5 minutes. So take a look at this. So over in Europe, Stockholm's index plunged by 8% in just 5 minutes before recovering most of those losses, which that caused just absolute havoc on other European indexes as well. Turns out it was a fat finger trade. It was human error that was actually made worse by some other factors that I'll tell you about in just a moment. But here's where it gets interesting. This is the same kind of crash that made history almost 12 years ago. Today, the day you should be watching this video. I'm making this video on Thursday for it's being released on Friday. Well, on May 6, 2010 is when we had the infamous flash crash here in the US. Now that crash sent the Dow Jones down by 1,000 points in just 10 minutes. It wiped out that's about 9% of the market. That was $1 trillion in equity value gone before just anyone knew what hit them. And maybe with the exception of 1987, up until that point, no one had ever really seen anything like that prior to 2010. So once again, just in a matter of seconds, the stage was set for the market to just completely unravel over the course of just of minutes, really. And these kinds of moves, I mean, they're too fast for human traders to respond to, let alone even the market's circuit breakers that are supposed to slow down these steep sell-offs. Couldn't really do anything to stop the bleeding. And so these flash crashes, we call them flash crashes because of their unprecedented speed. And thankfully, these events, these flash crashes, they're relatively rare. The result from, there's just a lot of different market forces coming together, everything from, now you've got artificial intelligence, you've had high frequency trading in place for some time now. And as we saw earlier, even a human error, a fat finger trade can be a trigger. Now, what makes those unique is that, with those flash crashes is that they unfolded in minutes. They happened in mere minutes. But since they began, what I've noticed, we've also seen more steep, what I'll call waterfall declines that can take the indexes down very, very dramatically in just a matter of days. In other words, we're investing. What we're seeing right now is just in the past, decade, is just an increasingly inhuman, an increasingly inhospitable, really, marketplace. So, and let me give you a couple examples of these waterfall declines that I'm talking about. Take a look at 2011, for example. That was an 18% decline that took place in only about 2 weeks. 2018 was a 12% decline that happened over just 11 days. And then, of course, go back to the start of the pandemic. 2020's bear market plunge was 35% that occurred in only 1 month. And so that's what I want to talk about today. I want to talk about some of the factors I'm monitoring, three specific conditions in place today that have me concerned that we could see whether it's another flash crash here in the U.S. or that maybe another waterfall decline is lurking right around the corner. So let's get into what those three conditions are here. All right, condition number one, major selling has already been taking place since last year. And now you're only now seeing that reflected in the big indexes like the S&P 500. So as we know, the S&P 500 is down 13%. through April to start the year. That is, by the way, its worst start since 1939. But look at what's already been taking place with stocks in the NASDAQ composite. So here's a chart. The bottom panel shows you a couple lines on here. This blue line shows how many stocks, once again, in the NASDAQ composite have seen a drawdown of 50%. You can see that number is at 45%. So 45% of stocks in the NASDAQ composite have been cut in half. They are down by 50%. You can also see that 20% of stocks that have plunged by 75%. But look at this. Look at where the selling started at on here. Those lines, they started to increase back at the start of 2021. And so when you see this kind of sustained selling just really deep into the red for the stock market, it means the market's foundation is growing weaker and weaker, at least is what you're seeing with these current prices. And now what you're seeing is that selling has come from names like, what we've seen this during earnings season, Netflix getting pummeled. You've seen that with Amazon, Meta. I mean, these stocks these are the names actually that were propping up the markets last year, despite all the selling elsewhere that was occurring underneath the hood. And when stocks are sold this deep, that bedrock, it's like a bedrock of institutional money that is going away. And that makes the stock market far more susceptible to those waterfall declines we're talking about earlier. And in fact, I think that's a part of the reason why the Dow crashed 900 points back on Friday last week. All right, condition number 2, volatility. Volatility is another factor, another defining factor when it comes to these waterfall declines and these flash crashes. And right now, I think there's more volatility in the market than what most investors and traders realize. When most investors think of volatility, a lot of times we talk about the VIX index. The VIX index is often referred to as Wall Street's fear gauge. It's because it tends to rise at volatility. It goes up when the markets are going down and vice versa. But other measures of volatility, they paint a different picture. I like to compare something called the average true range to the VIX. And here's why. So with VIX, you may not know this, but with VIX, this is a measure of what's called implied volatility. It is an estimate. It's an estimate of where traders think volatility is going over the next 30 days. But with average true range, it looks back over a certain look back period. It tells you what volatility is already doing. So it's not an estimate of what's going to happen. It's a look instead at what's already happening. And average true range is running at the highest level since that March 2020 crash. And so now here's my concern. If VIX follows suit, if we see the VIX index start to increase to similar levels, taking out similar levels historically, it could create this feedback loop that leads to that waterfall decline type event. And that's because of just the sheer number of institutional investors that now use volatility strategies. There's risk parity funds, there's funds that use volatility targeting, and simply put, when VIX increases, when volatility increases, they will sell to reduce their stock market exposure. That selling pushes VIX higher still, so they sell more, on and on. It's this feedback loop. And once again, this is not also just a conscious decision on their part. In most cases, it's largely driven by algorithmic trading. So it would automatically happen. There's an automatic trigger. The machines are create what I call a volatility trigger. Finally, condition number 3, a chart pattern has shown up. A chart pattern that I did not want to see show up has shown up here for the S&P 500 index. It's a unique, it's a highly specific chart pattern that last turned up, guess when? 12 years ago. 12 years ago, just before 2010's flash crash. Now it's a pattern called a diamond top, and I see this often occur at or near a market peak, just prior to a correction. And so here's 2010's scenario, how it played out. You can see the pattern is formed. First, you have sort of this expanding pattern marked by higher highs and lower lows, and then a contraction in the pattern. It's lower highs and lower lows, and then you see the breakdown. And you can see in 2010 how that occurred just prior to the flash crash when it happened back then. And then here's 2022's pattern. 2022 seeing a similar pattern set up, and since about mid-April, we've started to break down from that pattern. So those are the three conditions. And I have just one other thought here. Look, in action movies like The Matrix or the Terminator series, the plot is that mankind, it's overthrown by artificial intelligence. You know, the robots get smarter and they take out mankind. Now, the robots in these flicks, they always use brute force. You see shootouts, you see kung fu, but you know, as we see here in the real world, there are far more subtle about their takeover. And I mean, look, I mean, our technology, this information age, it's empowered just a whole new generation of traders, of algorithms that can think and act faster than what any human trader can. And this creates just a whole new kind of challenge for the average investor. And we must evolve, we must adapt so that we can continue to thrive. And once again, this just increasingly technology-driven market. And fortunately, there are the tools out there, things that we can monitor for what could happen next. And that's, you know, what I'm bringing up today. You know, stay one step ahead, keeping an eye on these chart pattern breakdowns, keeping an eye on volatility levels, you know, and discrepancies between realized and implied volatility, and how tracking how the average stock is performing, that participation under the hood, that can help you stay one step ahead of the next flash crash or the next waterfall decline, whatever it may be. All right. So that's it. This has been Clint Lee from the Bauman Letter and Big Picture, Big Profits. And just a quick reminder, please give me a like, please subscribe to our channel. And once again, I would love to hear your comments below on this very topic. Thanks.